In the third quarter of 2025, something shifted in global markets that most analysts completely overlooked. Chinese billionaires quietly pulled $47.2 billion out of U.S. equities. They didn't move it into Chinese tech stocks, European bonds, real estate, or digital assets. They moved it into physical gold stored in high-security vaults across Hong Kong, Singapore, and Switzerland. To the average investor, it might look like routine repositioning. But the scale and precision of this shift should concern anyone with exposure to American markets. The last time Chinese elites sold US assets this aggressively was in 2007. Within 18 months, the S&P 500 fell by more than half. The housing market imploded, and $8 trillion in American household wealth vanished. What triggered that collapse was not visible on the surface. But behind the scenes, Chinese capital was already leaving. The pattern is repeating. In Q3 2024, Chinese investors were net buyers of U.S. stocks, adding $23 billion. In Q3 2025, they became the largest net sellers ever recorded, reversing sentiment by $70 billion in just 12 months. These transactions line up almost dollar for dollar with China's surge in private gold holdings, bars, coins, exchange-traded allocations, and private vault storage. This isn't retail speculation. It's the country's wealthiest families, people with access to privileged information, making deliberate moves, and their actions raise a straightforward question. What do they see coming that others do not? Before understanding why China's wealthiest families are abandoning global markets and redirecting unprecedented sums into gold, we have to step back, far back, into the origins of their financial worldview. Because this shift isn't simply a reaction to quarterly data or short-term volatility, it reflects a deeper philosophy shaped by decades of instability, government intervention, capital controls, and a long memory of what happens when wealth in China is left exposed. To understand the present, you have to begin with the 1990 seconds. It was a decade of rapid change. The collapse of the Soviet Union, China's market liberalization, the rise of global financial networks, and the first wave of Chinese private wealth. Families who had lived for generations under strict state control suddenly found themselves permitted to accumulate capital. But unlike Western investors, whose financial traditions stretch back through centuries of stable property rights and private banking, China's new elites grew up with recurring cycles of policy shock. In the span of a single lifetime, they had seen property seized, businesses nationalized, and currencies revalued. By the time China joined the World Trade Organization in 2001, the wealthiest Chinese investors had already developed a cautious instinct. Profits could be made quickly, but wealth had to be protected quietly. The opening of China's economy exposed them to global markets. Yet economic freedom always felt conditional, a simple policy shift in Beijing. New regulations, capital restrictions, a corruption probe could erase fortunes overnight. This legacy produced a distinct financial identity. That conservatism evolved alongside China's rise. As exports surged and foreign capital poured into Shanghai and Shenzhen, Chinese elites explored new channels for diversification. U.S. markets became a favored destination. American equities offered liquidity, legal protections, and a sense of insulation from domestic political risk. By the early 2000s, wealthy Chinese families held billions in US stocks, not because of ideological alignment, but because American markets were simply a safer container for wealth. But even then, another foundation was forming, one based on deep skepticism of fiat currency. For Western investors, inflation was a background risk. For Chinese investors, monetary instability had been a lived experience. The memory of the hyperinflation of the late 1940 seconds lingered for decades. More recently, the yuan's unexpected devaluations in 2015 and 2016 reinforced the lesson. Currencies are tools of the state, and the state always has priorities beyond protecting private wealth. So it was no coincidence that China's wealthy began quietly accumulating gold years before the world noticed. Gold served as a hedge not just against inflation, but against intervention. It couldn't be devalued by decree. It couldn't be frozen by regulators. it carried no counterparty risk. Gold was the one asset that offered refuge from both Beijing's policy unpredictability and Washington's market cycles. In this way, the foundation for the 2025 shift wasn't a sudden insight. It was the culmination of decades of experience. This cautious mindset grew stronger as China's economic miracle matured. From 2008 onward, three interconnected fears shaped the way elites managed capital. The first was debt. China's rise had been fueled by an unprecedented expansion of credit, local government borrowing, property development, shadow banking, and corporate leverage. To the outside world, it looked like unstoppable growth. To insiders, it looked like a system balanced on momentum. Wealthy families saw firsthand how fragile the foundations were. Unfinished apartment towers, state-owned firms kept alive by continuous refinancing, and banks whose balance sheets depended on property values staying perpetually high. They knew the risks long before Western analysts began sounding alarms. The second was control. As Xi Jinping consolidated power, anti-corruption campaigns swept through the political and business elite. Some of China's most prominent billionaires disappeared from public view, summoned for disciplinary investigations, or forced to restructure their companies. The message was clear. Wealth was tolerated, but independence was not. Large fortunes made people visible, and visibility made people vulnerable. For many elites, the safest wealth was wealth kept offshore. The third was geopolitical uncertainty. As tensions between China and the United States grew, trade wars, sanctions, export controls, a new question emerged. How safe were Chinese assets held in American markets? Could they be frozen in a future conflict? Could Chinese nationals become subject to financial restrictions? Years earlier, Russia had been cut off from parts of the global financial system after the invasion of Crimea. Chinese investors paid attention. The idea that capital in U.S. markets was untouchable began to erode. During the 2010 seconds, these forces created an unusual financial ecosystem. Wealthy Chinese bought U.S. equities for growth, but at the same time, they accumulated gold for safety. They invested aggressively, yet prepared defensively. Then came the COVID-19 era lockdowns, supply chain shocks, and volatile markets. While large Western institutions responded with stimulus and risk-taking, Chinese elites took the opposite lesson. No system is stable, no market is permanent, and no government is fully transparent about crisis severity. The pandemic deepened mistrust of official data both in China and abroad. If a global crisis could erupt without warning once, it could happen again. By 2022 and 2023, hints of change began appearing. Private gold buying in China hit record highs. The yuan came under repeated pressure. Real estate giants like Evergrande and Country Garden revealed the full scale of their debt problems. And quietly, Chinese elites began re-evaluating their exposure to foreign markets. They didn't sell everything. They didn't panic. But they started to trim risk. The real turning point came in 2024. That year, U.S. markets reached new highs, driven by AI optimism and corporate earnings. But Chinese investors noticed something different. Markets were rising even as global growth slowed and geopolitical fractures widened. The pattern felt familiar, similar to 2006 and early 2007, when markets remained euphoric despite deteriorating fundamentals. At the same time, China experienced its own stresses. Capital controls tightened again. Property sales weakened. The government took a more active role in directing investment flows, signaling growing concern over stability. Yet in Q3 2024, Chinese investors bought $23 billion of U.S. equities. To outsiders, it looked like confidence. To insiders, it was the final extension of a strategy that had reached its limit. Because behind the scenes, another force was emerging. Throughout the early 2020 seconds, China had been increasing its national gold reserves, promoting yuan-based trade, and building alternative payment networks. But these state actions quietly influenced private capital behavior as well. Financial infrastructure was a liability. Then the wealthy likely felt the same pressure. So by the time 2025 arrived, All the underlying conditions were in place. The accumulated memory of financial instability, the rise of political centralization, the expansion of debt, the growing risk of U.S.-China confrontation, the historic role of gold as a hedge against both Washington and Beijing, the sell-off of U.S. equities in Q3 2025 wasn't the beginning of a story. It was the conclusion of one. It represented a worldview shaped over decades, a worldview that taught China's rich to move early, move quietly, and move into assets that cannot be altered by policy or politics. The origins of the $130 billion shift into gold lie not in sudden fear, but in long-term calculation. What the world saw as a surprising move was to China's elites. And this deep-rooted history is what sets the stage for the next phase of the story. How China's wealthy transformed caution into strategy, and strategy into a movement powerful enough to shake global markets. By the early 2022s, Chinese wealth was no longer a quiet domestic phenomenon. It had become a global force, one that shaped real estate markets from Vancouver to Sydney, influenced commodity cycles, and steered capital flows into American tech giants. Yet behind this expansion was a steadily evolving strategy, a shift from opportunistic investment towards something more deliberate. The rise of this strategy is what ultimately led to the coordinated move into gold in 2025. The transformation began when China's wealthy realized they were no longer simply beneficiaries of the global system. They were now stakeholders, with the ability to move markets. The 2010 seconds had shown them how quickly capital could change the trajectory of entire industries. A few billion entering or exiting a sector could inflate valuations, distort supply chains, or crash a market seemingly overnight. This new awareness created a more sophisticated class of investors, one that watched geopolitical and macroeconomic signals as closely as earnings reports. What accelerated this shift was technology. Chinese family offices, once relatively conservative, began adopting advanced risk models, data analytics, and AI-driven forecasting used by top hedge funds. With access to private research and government-linked intelligence, they saw global trends earlier than most Western investors. They tracked capital flight patterns, supply chain vulnerabilities, debt cycles, and currency pressures in real time. This wasn't intuition, it was structural awareness, and that awareness pointed toward a world entering a period of prolonged instability. As China's influence grew, so did the sensitivity of its wealthy to political signals. They learned to interpret subtle cues from Beijing, a shift in rhetoric, a policy speech, a regulatory investigation as indicators of future turbulence. When the government began emphasizing national security in economic matters around 2020, the wealthy took notice. When discussions of self-reliance intensified, they reassessed the long-term viability of assets tied to American financial systems. To Western observers, these were policy themes. To China's elites, they were warnings. Meanwhile, the domestic environment was becoming increasingly complex. China's property market, long the backbone of household wealth, began showing signs of strain. Developers missed payments. Construction slowed. Pre-sale models faltered. The wealthy realized their local assets were highly exposed. The government insisted that risks were contained, but private intelligence painted a more nuanced picture. Debt levels were staggering. Consumer confidence was weakening. Local governments depended heavily on land sales. These were not temporary setbacks. They were structural cracks. As domestic concerns grew, the U.S. market appeared stable by comparison. American tech stocks delivered strong returns. The dollar remained dominant. Liquidity was abundant. For years, Chinese investors used U.S. equities as a counterbalance to domestic uncertainty. Export controls on semiconductors, sanctions on Chinese firms, investigations into foreign investment flows. The wealthy started viewing the U.S. not as a safe haven, but as a potential risk zone. This was the moment when gold began its steady rise, not as a reaction to panic, but as a strategic migration. Chinese family offices increased gold allocations quietly, testing storage facilities in Singapore, Zurich, and Hong Kong. They diversified between bars, coins, ETFs, and private vaulting. They studied historical correlations between gold, equities, and global crises. They recognized that gold behaved differently from anything else. In their portfolios, it had no political allegiance, no default risk, no exposure to sanctions. By 2023, they weren't just hedging, they were preparing. The rise of this strategy became more visible when China's central bank began aggressively increasing its own gold reserves. Official purchases signaled to the wealthy that gold was not merely a personal hedge, but a national priority. While Beijing never announced such intentions directly, the alignment between state actions and private capital flows became unmistakable. When a government accumulates gold, it reflects a view that the future will be shaped less by trust and more by collateral. In early 2024, financial institutions in Asia began reporting unusual trends. Private banks saw wealthy Chinese clients diversifying out of long-held U.S. stocks. Vault providers reported rising inquiries. Gold refiners observed a surge in orders from Asia. None of these movements were dramatic enough to attract global attention. They were incremental, methodical, almost invisible unless viewed collectively. What turned these private strategies into a decisive movement was the widening gap between market optimism and underlying instability. U.S. markets surged on enthusiasm for artificial intelligence. While global manufacturing slowed, debt levels reached new records, and geopolitical tensions escalated. Chinese investors recognized the same divergence they had seen before the 2008 crisis. Markets celebrating growth, while the fundamentals signaled fragility. By mid-2025, the pattern crystallized. The wealthy began reducing exposure, not because of fear, but because of conviction. They believed the global financial system was heading toward a correction, maybe not immediately, but inevitably. And they were determined to be early, not late. The result was the largest coordinated shift of private Chinese wealth in modern history. Billions leaving U.S. equities, and almost the same amount reappearing in gold holdings. What looked like a sudden move in Q3 2025 was actually the culmination of years of transition, a rise marked by deeper awareness, higher sophistication, and a growing belief that the world was entering a new era, one where the safest position was outside the system, not inside it. The shift of China's wealthy into gold did not happen in a vacuum. It emerged from a period defined by conflict. Conflicts inside China's economy, conflicts between China and the West, and conflicts within the global financial system itself. And as these pressures built, they exposed contradictions that had been hidden beneath years of growth and confidence. For China's elite, these contradictions signaled something more dangerous than volatility. They pointed to a system approaching its limits. The first conflict was internal. China's model of growth, debt-fueled construction, export-led manufacturing, and strict political control was no longer producing the stability it once promised. The property sector, which had been a dependable engine for 3 decades, began unraveling. Developers defaulted on loans, homebuyers lost confidence, and half-built towers dotted major cities. The wealthy watched the government attempt to manage the crisis by shifting blame, tightening credit, then loosening it again, creating an unpredictable cycle of intervention. This was more than an economic problem. It was a breach of trust. China's elites realized they were operating inside a system where transparency was secondary to stability, and stability was weakening. When officials insisted the property crisis was manageable, but internal reports suggested otherwise, and filtered information could not protect their fortunes. The second conflict was geopolitical. As US-China relations deteriorated, both countries began weaponizing finance, technology, and trade. Chinese firms were added to sanction lists. American companies faced restrictions in China. Export controls hit critical industries like semiconductors. Even cross-border investment drew scrutiny. What once felt like routine rivalry became a structural confrontation, one that might span decades. For China's richest families, many with assets in the U, not market risk, but political risk. If relations worsened, their assets could be frozen. Their holdings could become bargaining chips in diplomatic disputes. The safety they once saw in American markets began to feel conditional. The third conflict was global. By 2024 and 2025, major economies were struggling with rising debt, slowing growth, and fractured supply chains. Central banks attempted to manage inflation with aggressive interest rate hikes, yet government deficits ballooned. Investors believed technology would offset these pressures, but deeper structural issues, aging populations, declining productivity, and geopolitical fragmentation were eroding confidence beneath the surface. Chinese elites, equipped with sophisticated models and long-term memory, recognized these contradictions early. They saw Western economies projecting confidence while wrestling with internal vulnerabilities. They also saw how quickly optimism could unravel. The 2008 crisis had shown them that the trigger for collapse often appeared obvious only after the fact. But the most important conflict was psychological, the tension between opportunity and survival. For years, China's wealthy had operated with a dual mindset. They chased returns in global markets, yet kept one eye on the exit. They expanded their businesses, yet prepared for policy shocks. They enjoyed the benefits of globalization, yet feared becoming casualties of it. By the mid-2020s, this psychological split became unsustainable. The world was no longer offering the stability that had allowed them to operate in both modes at once. The contradictions burst into the open in 2025, when a series of events sharpened their concerns. A wave of unexpected corporate bankruptcies in China exposed hidden weaknesses in the financial system. Rumors circulated about new capital control measures. Meanwhile, U.S. regulators signaled potential restrictions on foreign investment tied to geopolitical risk. Each event reinforced the same realization. The global financial system was entering an era where wealth could be trapped, targeted, or reinterpreted through political priorities. The elites concluded that the greatest threat wasn't market volatility, it was the system itself. A system too interconnected to escape, yet too unstable to trust. A system where governments on both sides were willing to use money as leverage. In this environment, gold transformed from a hedge into a form of resistance. It became the asset that transcended conflict beyond sanctions, beyond policy changes, beyond the reach of political maneuvering. For China's rich, buying gold was not just a financial decision. It was a declaration of independence from systems they believed were nearing a breaking point. Gold was their answer to corruption, contradiction, and escalating conflict, and their decision to embrace it would soon collide with the global markets they once fueled. By the time the world noticed the scale of Chinese wealth shifting into gold, the transformation was already underway. Markets tend to interpret change slowly, but capital. And as the elite completed their repositioning in mid to late 2025, the global financial system began showing signs of strain. The first signs appeared in U.S. equity markets. Throughout 2025, stock indices remained near record highs, driven largely by confidence in technology and corporate earnings. But beneath the surface, liquidity began thinning. This wasn't caused by retail sentiment or institutional rotation. It was caused by the quiet retreat of foreign investors led by China's wealthy. Their exit didn't crash prices, but it altered the structure of demand. Stocks that once relied on consistent foreign inflows became vulnerable to even modest corrections. Analysts framed it as profit-taking, unaware that it was part of a much larger reallocation. The second sign emerged in currency markets. As capital flowed into gold, pressure on the yuan intensified. Investors expected the Chinese government to intervene aggressively, but Beijing allowed the currency to slide more than expected, signaling a shift in priorities. A weaker yuan helped stabilize exports, but sent a clear message to domestic elites. The government would manage the macro picture, not preserve private wealth. Those who had already diversified offshore felt validated, those who hadn't accelerated their efforts. Meanwhile, global markets began confronting a new reality. A major source of liquidity had quietly withdrawn. For years, Chinese capital bolstered everything from U.S. tech stocks to Southeast Asian real estate. Its retreat created what economists call an invisible vacuum, a slow erosion of demand that doesn't trigger immediate collapse but undermines stability over time. The effects appeared subtle at first: lower trading volumes, weaker foreign direct investment, declining venture capital in certain sectors, but the trajectory was unmistakable. The global system, which had grown accustomed to China's participation, now had to contend with its partial disengagement. Inside China, the transformation was equally significant. The government, aware of capital outflows, tightened reporting rules, increased scrutiny on overseas transactions, and promoted domestic investment with renewed urgency. But these measures didn't change the underlying calculation of the wealthy. Many viewed them as confirmation that the window for moving money abroad was narrowing. Families who had waited too long to diversify began seeking alternative channels. Gold itself experienced a transformation. For decades, it had been treated as a defensive asset, one that investors turned to only during crises. But in 2025, it began functioning more like a parallel currency. China's surge in private demand, combined with ongoing central bank purchases worldwide, pushed gold into a new strategic role. It became a store of value for those who believed the next global crisis would not be financial. This shift reverberated across international markets. Nations dependent on global capital flows, emerging markets, commodity exporters, infrastructure-dependent economies began experiencing shortages of foreign investment. Some governments downplayed the decline. Others introduced incentives or tax reforms. But none could replicate the scale of Chinese private wealth once it turned inward. And yet, this period was not purely a collapse. It was also a transformation, a reordering of priorities among the world's most influential investors. China's wealthy were no longer chasing growth. They were preparing for endurance. They weren't fleeing markets. They were repositioning themselves for what they believed the next decade would bring: slower globalization, deeper geopolitical fragmentation, and growing instability in currencies and debt markets. In their eyes, gold represented the foundation of a new strategy, one built not on optimism, but on resilience. The global financial system, shaped by decades of interconnected growth, was entering a new phase, and they intended to survive it on their own terms. When historians look back on the mid-2022, they may not focus on the headlines that dominated the news: trade disputes, interest rate battles, or quarterly earnings. Instead, they may point to something quieter: the moment when China's wealthiest families pivoted away from the global financial system and built a parallel foundation for their future. Their move into gold was not dramatic, not loud, and not intended to send a message. Yet its legacy may shape the next decade more than any public policy announcement. The first part of that legacy is psychological. For decades, they believed they could navigate both systems, profit from global markets while guarding themselves against domestic volatility. But by 2025, that dual strategy unraveled. They no longer saw the U.S. financial system as insulated from geopolitics, nor the Chinese system as predictable enough to trust. Their choice to concentrate wealth in gold signaled something deeper than caution. The second part of the legacy is structural. Chinese capital had been a stabilizing force in numerous markets, often filling gaps that domestic investors or Western institutions left behind. When that capital retreated, the effects were subtle but cumulative. Some sectors lost liquidity. Some countries saw declines in foreign investment. Even major economies noticed shifts in demand patterns that had been consistent for years. Markets accustomed to Chinese participation were now forced to adjust to its absence. But the most significant legacy lies in the message this movement conveyed: that even the wealthiest, most well-connected investors in one of the world's most powerful nations no longer trusted the traditional pillars of global finance. Not because of conspiracy, and not because of panic, but because they concluded that the underlying assumptions of stability, cooperation, and transparency had weakened. Gold, in this context, was not simply a commodity, it was a verdict on rising political risk, a verdict on overstretched debt systems, a verdict on the fragility of global trust. For China's elite, gold represented continuity in a world they saw becoming unpredictable. It was a way to anchor wealth when currencies could be manipulated, when markets could be frozen, and when geopolitical tensions could escalate without warning. Whether or not those fears become reality is still unknown, but what matters is that these investors acted on the belief that the next era would demand resilience, not optimism. And that belief carries implications for everyone else. If the wealthiest families in China who possess access to private intelligence, political signals, and global financial networks decided that gold offered more security than American markets. What does that say about the decade ahead? If their actions mirror the patterns seen before previous global downturns, what responsibility do others have to understand the logic behind those moves? Their shift does not guarantee collapse, but it does reflect a world losing its sense of predictability, a world where power is more fragmented, where trust is harder to maintain, and where the safest choices may no longer be found within the financial systems that once felt untouchable. In the end, the movement of China's wealthy into gold is less about metal and more about mindset. It marks the moment when one of the world's most influential investor classes collectively chose independence over integration, caution over confidence, and durability over growth. It is a reminder that markets can be deceived, but money rarely lies. Thank you for watching this video. Click here to watch another video that might interest you,